Hello and welcome everybody to this discussion on what is risk adjustment. And we welcome you to the presentation. So what is risk adjustment? Risk adjustment is an actuarial term. And in case you don't know what an actuary is a risk management professional who uses mathematics, statistics, and financial theory to assess risk and uncertainty. So let's take a look. Let's take a deeper dive. Pardon the pun here. So we have products that are shipped across oceans from our country to others and from other countries to ours. And when that stuff goes on a boat, you'd better believe that that boat is insured. Okay, in case this happens. Is it gonna happen? Probably not. Can it happen? Absolutely. Which ship will it happen to? Don't know. Why will it happen? Weather, pirates, malfunction, what have you. So again, this is about managing risk. Okay, let's take another example here, because if we knew what an insured event would cost, we wouldn't need insurance and likely we wouldn't be able to get it. Okay, so in other words, if you knew that that ship was gonna sink, okay, who would insure it? They would say, I mean, it would cost more to insure it than the loss would be. Otherwise, there would be no incentive to insure it, right? So it is about an insurance company assuming risk for an individual and spreading that risk over a population. So we're going to look at this a couple different ways. We've already looked at it with a ship. Look at homeowners insurance, okay? Why do you have homeowners insurance? And fire is certainly not the only reason. Could be flood, could be in case somebody falls down your steps, what have you. But we're going to just take the scenario of fire, okay? There's about a 1 in 850 chance that your house will catch fire, okay? And so you could assume that risk yourself, and if your house burns down, you're on the hook. You suffer the loss. Okay. Now, the average homeowner policy for $250,000 worth of coverage is $1,428 per year, $1,428 per year. So it would take 175 years for you to have paid $250,000 to get that coverage. So it's certainly a wise investment to pay $1,428 a year in case your house catches fire. Okay. Now, you could have buyer's remorse and say, after 10 years, I paid $14,280 and my house hasn't burned down. Okay, that's hindsight, and you should consider yourself fortunate. However, the opposite side of that is, if your house burns down and you haven't paid the $14,280, well, now you're going to be losing a little over $220,000. So, this is, insurance is insurance. It's not a guarantee, and the guarantee is that you will be indemnified. You'll be covered for a loss, okay? And you could regret paying that for that security if you don't need it. But that's, you can't have it both ways, okay? So again, if you knew that you wouldn't need the insurance, then there would be no need for it. You wouldn't be able to get it, or you wouldn't be able to afford it, right? So, you buy insurance in case you are the 1 in 850, right? So, when you pay that money, that goes to this umbrella that covers you. Okay, and you may need a penny from that fund. You may need a nickel. You may need a quarter. You may need $100. Okay, but that's the nature of insurance. Is that insurance companies spread out the risk and cover a population or a range of boats, houses, cars, people, what have you, and it redistributes that risk. And actuaries sit down and figure out through statistics and historical data, etc., a number that makes sense. Okay. So insurance is about two things. It's about measuring risk, and it's about distributing risk. Okay, that's what insurance is all about. And so this is done through a process called predictive modeling. And predictive modeling is a commonly used statistical technique to predict future behavior. Predictive modeling works by analyzing historical and current data and generating a model to help predict future outcomes. Okay, and we're gonna talk much more about this, throughout the program. Okay, but risk adjustment is based on measuring risk and distributing risk, and a key factor in that is called predictive modeling. So let's talk about health. Okay. The healthy person who maybe goes to their doctor once a year for an annual physical, get checked out, do the blood work, etc., is going to be relatively low risk. Now, is that no risk? No, a tree could fall on them, a bus could hit them, they could get some virus or some illness. Okay, so there's no such thing as no risk. Okay, but there are those who maybe have chronic conditions, may have conditions that could lead to an acute condition such as heart disease, etc., diabetes, diseases that can progress. And so that person would be higher risk. Okay. But the purpose of insurance is not to assume for any one person or party to assume the risks themselves. Of course, if you do that, then we go back to that $250,000 house. If you don't have insurance on that house and it burns down, you've assumed all the risk. Okay, so this is the nature of insurance, and so it's about, again, measuring risk and distributing risk. Okay. And so the average cost of health insurance in the U.S. is $560 per month. Okay, and that annualizes to $6,720. Okay, and so for the person who is healthy, okay, goes to their doctor once a year, right? Doesn't have any health problems. Okay, they may be saying, "This is not a good deal for me. I mean, I'm not, my doctor visit cost me $200. Okay, but I paid $6,720, and the $200 went to my deductible." So you could look at that, in a vacuum. You could look at that in an isolated perspective, and you could say, well, that was a losing proposition for me. Okay, till next year when you get hit by a bus or a tree falls on your head or what have you. Okay, so again, it is not about it's not a zero-sum game. It is either preparing for the unknown, the unexpected, the questionable, or rolling the dice and gambling, like that house for $250,000, right? So, and your health is certainly, people's health is certainly worth more than $250,000. But again, this is about managing risk and spreading risk over a population. Okay. So, what is risk adjustment in healthcare? It's based on health status and adjusts some financial component of the cost of healthcare coverage. Okay, and what and how depends on the coverage. And it's very important to note that risk adjustment is associated with the cost of providing healthcare benefits or insurance. It's not about claims processing or claims payment, right? So, how much is your homeowner's insurance per month? Okay, that is based on the risk of a claim, whether it be fire, flood, somebody drives off the road and drives into your house, the side of your house, or a tree falls on your house. What is the probability? What is the risk? And what is the value that what is the amount to be paid should there be a claim? What is your claim's history? All these factors. The claims payment happens after there's a loss. Okay, this is about predicting the probability, measuring the risk, and distributing the risk. Okay, and so in healthcare, it's adjusting some financial component. Okay, and it really does depend on the coverage, and we'll take a look at this here in a second. So just to repeat, risk adjustment is an actuarial tool used to adjust payments for healthcare coverage based on health conditions or the risk of the enrollees, right? Remember the person with the chronic pain, the chronic back condition, chronic heart condition, diabetes, they're going to be more costly than the average healthy person, right? So their risk increases. A healthy individual incurs a lot less medical expenses than an individual with serious conditions. Okay, but again, when we're measuring risk and redistributing risk, okay, this is not about an individual. This is about a population. Okay, so more resources are needed to care for the less healthy population, especially for those who are chronically ill, and this is predictable through predictive modeling. Okay. So many of you, are used to, perhaps having insurance through an employer, health insurance through an employer. This is called group coverage. Okay. And that is still, the premiums are still arrived at by actuarial processes, experts in measuring risk, determining the risk of expense, etc. Okay, and so you may have had a payroll deduction, where you contribute to your health insurance, or maybe your employer provides, doesn't have you contribute. Maybe they pay the full thing. Okay. Now, you may look at your health insurance on your paycheck and say, wow, $77, $150 a month, and we're assuming this is a 2-week pay period, $150 a month. That's a lot less than the $500 that we talked about earlier. In a vast majority of cases, when you have insurance through an employer, the employer is by law required to pay 50% or more of the premium. So if you're contributing $150, then you are contributing only 49% or less. So it wouldn't be 150; it'd be at least 300, and unless you unless you're privy to that information, you don't know what the percentage is. But you do know that in a vast majority of cases, it's a requirement for the employer to pay 50% or more. Okay, so that's group health insurance. That's the way that works. But risk and you don't need risk adjustment there because that's called a group policy, and the policy is sold, and every person is going to pay the same. In other words, there is no risk adjustment because the group, the employer has negotiated, cover my 200 employees. How much is it going to be per employee? And the insurance company says $500 per month per employee. So there is no risk adjustment because the premium is the same per person. Okay. Now, there are other other coverages besides group health insurance through an employer. Okay, and in these three, the risk adjustment is used in these three: Medicare, Medicaid, and the Affordable Care Act marketplace individual and small group plans. Okay, and we will certainly be looking at these in more detail throughout the course. Right now, we're just talking about what the overall concept of risk adjustment. So in Medicare and Medicaid risk adjustment, health plans receive higher payments from sicker enrollees and lower payments for healthy enrollees. So Medicare, in about half of the beneficiaries that are eligible for Medicare are covered by commercial plans, commercial carriers that are contracted to provide Medicare benefits for beneficiaries. And so CMS, the government, is no longer paying those claims for Part A and Part B. Now a commercial carrier is. So Medicare is essentially buying insurance coverage for the Medicare beneficiaries, right? And so the arrangement here is risk adjusted so that a beneficiary who is low risk the carrier will receive one premium, but if a beneficiary is higher risk, the carrier will receive a higher premium. Same thing with Medicaid. Okay, so in Medicaid states that and not all states have a risk adjustment process in place, and we'll talk about this in a specific module relating to Medicaid. But in states where Medicaid contracts out some of its beneficiaries to health insurance carriers and to provide Medicaid coverage. Again, the same thing. It is the higher risk, lower risk plans receive higher risk plans receive more money, lower risk plans receive less money. Okay, and in the ACA, or the Affordable Care Act marketplace and individual small groups, now we've got these insurance carriers covering beneficiary, covering the population. Okay, and this works a little different. So let's take a look at this. Okay, in commercial, okay, all these carriers that sign individual policies or even small group policies, you got Plan A, you got Plan B, you got Plan C, right? And they're all writing policies under the guidelines of the Affordable Care Act, all right? And so all the health plans pay into a pot, okay? When a plan has higher risk than the other plans comparatively, that plan is able to draw from the pot to level out the disparity in risk between the plans. Okay, and we'll talk about this again more in specific modules. We'll do a module on Medicare, Medicaid, and commercial plans. We'll dive deeper into this. But again, risk adjustment is measuring risk and distributing risk. Okay, and so measuring, identifying risk, measuring risk, and then managing risk. And that is the foundation of risk adjustment. And so throughout the course, we will look at how it's measured, what are the sources to gauge measurement, what is a risk, how do we measure it, how do we quantify it, and that's called a risk score. And we will talk much more about this. It's a lengthy subject, so we will break it down into easy to understand parts, but hopefully that gives you an insight as to what risk adjustment is. And we will continue throughout the program to explain this in greater detail for you.